Welcome. Have you ever wondered what rules companies follow when they prepare their financial reports? The answer is accounting concepts. These aren't just technical terms, they're the fundamental principles that make financial statements reliable and consistent. In this video, we'll quickly break down the most important concepts, like the business entity and going concern principles. Understanding these ideas is key to reading any financial report with confidence. Let's get started. What are accounting concepts? Accounting concepts are fundamental principles and assumptions that serve as the foundation of financial accounting. They provide a standardized framework for recording, classifying, and reporting financial transactions, ensuring that financial statements are consistent, reliable, and comparable. These concepts are crucial for preparing financial information that is useful to internal and external stakeholders such as managers, investors, and creditors. Business entity concept. This concept states that a business is considered a separate and distinct legal and economic entity from its owners. The personal affairs of the owner are completely separated from the business's financial records. For example, if an owner uses personal funds to pay a business expense, it is recorded as an increase in the owner's capital in the business, not as a cash receipt. Conversely, any personal withdrawals by the owner are treated as a reduction in their capital, not a business expense. This clear separation is essential for accurately measuring the business's profitability and financial position. Money measurement concept. According to this concept, only those transactions and events that can be expressed in monetary terms are recorded in the accounting books. This provides a common unit of measurement, e.g., dollars, rupees, euros, that allows for the aggregation and comparison of diverse business activities. Qualitative information, such as the skill of employees, the reputation of the company, or customer satisfaction, is not recorded in the financial statements because it cannot be reliably quantified in monetary terms. Accounting period concept. This concept dictates that the life of a business, which is assumed to be indefinite, is divided into specific time intervals or accounting periods for the purpose of financial reporting. These periods are typically a fiscal year, but can also be quarters or months. This allows for the regular assessment of a business's performance through an income statement and financial position through a balance sheet and enables stakeholders to track progress and make timely decisions. Accrual concept. The accrual concept requires that revenues and expenses are recognized in the period they are earned or incurred, regardless of when cash is actually received or paid. It includes revenue recognition concept and expense recognition concept. Revenue recognition. Revenue is recognized when a good or service is delivered or when the earning process is substantially complete, not when the cash is collected. Expense recognition. Expenses are recorded when they are incurred to generate revenue, not when the cash payment is made. This provides a more accurate picture of a company's profitability during a specific period. Matching concept. This concept is an extension of the accrual concept. It states that all expenses incurred during a specific accounting period should be matched against the revenues earned in that same period. The goal is to accurately calculate the net profit or loss for the period by directly linking the costs of generating revenue to the revenue itself. For example, the cost of goods sold is matched with the revenue from the sale of those goods. Going concern concept. This is a fundamental assumption that a business will continue to operate for the foreseeable future and has no intention or need to liquidate its assets. This concept justifies the valuation of assets at their historical cost rather than their lower liquidation value. Without the going concern assumption, all assets would have to be valued at their immediate selling price, which would significantly alter the financial statements. Cost concept, historical cost principle. According to this principle, assets are recorded at their original purchase price. This includes all costs necessary to acquire the asset and get it ready for use. For example, the cost of a machine would include its purchase price, shipping costs, and installation fees. The historical cost principle provides an objective and verifiable basis for valuation, as the cost can be confirmed by invoices and receipts. Subsequent changes in market value are generally ignored. Realization concept. This concept, also known as the revenue recognition principle, defines when revenue should be recognized. Revenue is considered realized when a good or service has been delivered and the company has a legal right to receive payment. This is a critical point in time for recognizing revenue, as it signifies that the earning process is complete. Any income that is not yet realized is considered unrealized and should not be recorded as revenue. Dual aspect concept. This is the foundational principle of the double entry bookkeeping system. It states that every financial transaction has a twofold effect. For every debit, there must be a corresponding credit of an equal amount. This concept is expressed by the fundamental accounting equation: assets equiliability plus owner's equity. This principle ensures that the accounting records are always in balance, as every transaction affects at least two accounts. So, there you have it, a quick overview of the essential accounting concepts. Remember, these principles are the foundation of all financial reporting. They ensure consistency and accuracy, allowing you to trust the numbers you see on a balance sheet or income statement. By keeping these core ideas in mind, you're now better equipped to understand how and why companies report their finances. Thanks for watching, and don't forget to like and subscribe for more.